Hey guys, Toby Mathis here. Question I get quite often is what are the benefits of starting a nonprofit? And so I'm just going to break this down into components to make it pretty easy. Number one, whenever you're engaged in any sort of business activity, it's always best to run it through an actual business entity. And a business entity is set up in two flavors, for profit or non for profit. In the for profit realm, we have LLCs, you have your limited partnerships, you have limited liability partnerships, you have all these wonderful flavors of things that you could do. The most common are LLCs and corporations. And then you pick on how it's going to be taxed. And so, like, for example, an LLC doesn't exist to the IRS. You have to tell it whether it's going to be ignored for tax purposes, recognized as a partnership, recognized as a corporation, and if so, whether it's going to be an S or a C. But those are for profit enterprises. About 99.9%, you're always going to be in the realm of corporation or LLC. And then from a tax standpoint, you're going to be one category, either sole proprietor or ignored. Partnership, which is two or more people for profit. Number three would be like a S corporation or a C corporation. That's really our world from a standpoint on the for-profit side. On the not-for-profit side, you get into this, it's almost always going to be a corporation, a nonprofit corporation. And then from a tax designation, it's going to be under 501. So you're going to either be a 501c 1, 2, 3, 4, 5, 6, 7, 8. Like there's more than 20 flavors. The most common that you see is something called a 501c3, where the individual who's giving money to it can write it off as a charitable donation versus something like a business association where it's not charitable, but it's exempt for tax purposes. If I gave it money, I can't write it off as a charitable donation. So it's kind of like United Way is a 501c3. I give it money, I can write it off as a charitable donation on my tax return. If I went down to the local chamber of commerce and gave them money, I cannot. If I'm a business, I could write it off as a business expense. But that's, again, kind of different flavors of the nonprofit realm. What's the big benefit of having a nonprofit is that it is not owned by you. It's not yours. So, for example, if I go out and I get into a car accident, I don't have to worry about them taking away a nonprofit. If you are the director of a nonprofit and you get sued for defamation, or you default on your mortgage, or you rack up credit cards up to your eyeballs and you go bankrupt, you don't have to worry about it affecting the nonprofit because the nonprofit is its own animal. If you die, you don't have to worry about the nonprofit being affected because there's nothing that you own of the nonprofit. It's completely separate. It's its own little island. So for estate tax purposes, I don't have to worry about it being included in my estate. I don't have to worry about it being probated. I don't have to worry about any of those things because it's not owned by anybody. The profits do not automatically inure to me. Unlike if I owned a partnership or a sole proprietorship or an S corporation, those profits are going to hit me even if I don't take the money out. And it's still going to flow onto my return. A C corp is going to be taxed at the C corp level. And then if I take it out and use any of that money, I'm going to have dividends, right? Or if I take a salary out, all that stuff, I don't have to worry about 9 out of 10 of those inside of a nonprofit. The only thing I have to worry about is if I pay myself a salary, and I'm not required to pay myself a salary. So I could set up a charity. I can run a nonprofit. I don't have to worry about paying tax on it. If all I do is leave the money in there, I'm never worrying about taxes. The sole exception is if I do something called UDFI or unrelated business income tax, like I'm running a traditional business out of there that's not part of my charity. For example, if I have a McDonald's that I'm running in there, I'm going to have to pay tax on that because it's not a charitable activity. If I own an investment in McDonald's and it pays me dividends, I don't have to pay tax on it as long as I'm using it to further my charitable, my charitable purpose. So if I have a charity, and let's just say it's a low income housing, affordable housing charity, and all I do is I donate money to it, and it just operates, and I seek donations from other people, and maybe I'm really pushing out there trying to get people to donate their old rental houses, see if I can't get some estates to bequeath things to it, going out hitting up people in the community saying, hey, will you donate to this? It's for the less fortunate or lower income housing for families, and I end up with 50 rentals in it, and it starts making really good money, I don't have to worry about paying tax on it. I don't have to worry about it automatically hitting me. Now, can I take a salary out of it? Of course. I can take a reasonable salary. And what is reasonable? Whatever the market would hold. I mean, there's again, it's not an automatic limit. So, for example, on one end of the spectrum, you may use a university as an example because they're pretty easy, and just about every university is a charity. Princeton, Harvard, University of you name it, whatever state, it's going to be a charity. University of Alabama, for example, Nick Saban is the coach, makes tens of millions of dollars a year, if not more. That's a charity. So there's no cap on it that says, hey, this is how much you can make. It's just whatever the market bears. So you could pay yourself whatever's commensurate to whatever kind of charity it is, and it's whatever's reasonable. And I would use an accountant or an attorney to kind of look at that, or you go to salary.com and try to figure it out for your community and say, hey, here's a reasonable salary for me to take. But there's not an automatic maximum on it, and there's not an automatic minimum on it. It's just whatever I could pay somebody else to do whatever the activities are. So you can always get money out in that fashion. My experience is that most people that set up nonprofits, and specifically charities, 501c3s, it's usually a one-way road. They're usually getting money into it, and they're really working hard to build it for a personal reason, or because they want to create a legacy, or they want their family to continue to sit on the board and continue to interact with that business. It's an interesting way to do estate planning because it's not part of the estate. So if I have a $20 million estate, husband and wife, I don't have federal income taxes. Maybe I might be looking at state. If they change that rule, and all of a sudden it's like, I have a $10 million estate and it's taxable, or let's say that $10 million and below is not taxable, 10 million above is, and I have a $20 million estate, that means that 10 million would be taxable. I could start unloading it and giving it away, perhaps to a charity or to a foundation. A foundation is a non-operating, it's not really doing anything. It's just a charitable organization sitting there, and it gives away money to operating charities. So if I'm running an operating charity, I don't have to worry about that. But maybe I'm just going to give $10 million to it. I'm going to start unloading my assets to get it out of my estate. And what am I going to do? I'm going to have my kids or people I care about working on the board, and they get a salary. That's fantastic. And they can grow the charity over time. And maybe that's their legacy. I'm not going to just give them a bunch of money. Maybe I give them some and let them work for the charitable side. So anyway, I'm giving you I'm giving you the short and sweet of it. What are the real benefits? I don't have to worry about personal liability coming in and taking those assets away. It is exempt from taxation. If I have real estate in there, I can apply for exemption even from county real estate taxes. I don't have to worry about federal income taxes on those funds unless I pay myself a salary. I'm allowed to pay myself a salary. It becomes a really nice vehicle for estate planning. It's not included in my estate. So those are just some of the benefits that come along with setting up a nonprofit. And again, there's tons of flavors. There's lots of things that you never realized were a nonprofit that are actually a nonprofit out there. The NFL was a famous nonprofit till they took itself and said, hey, we're going to make that back into for-profit. The NHL, National Hockey League, Major League Baseball, those are charities. IKEA is still a charity. A lot of people don't realize it's owned by charities. It flows up, but it's always set up as a charity. There's just some interesting things out there that people don't realize. And you're like, wow, you're scratching your head. United Way is obviously a big one that you see out there. And then you have these massive foundations which support the operating charities. So you have like the Gates Foundation, the Clinton Foundation, all these big ones. One of the biggest ones is the foundation that actually owns IKEA. They're all intertwined, but they're some of the biggest in the world because they don't pay taxes, and they can grow their investments tax-free over a long period of time, which allows them to get into that exponential growth phase. It goes, and that's a huge benefit, is that you're not paying tax as you go. So you end up creating really cool legacies. I love using them with folks, whether they're big or small, it doesn't matter. What I care about is people that are passionate about something, and there's so much benefit you can get. You can go out and solicit monies from other people if it's a charity, and and you can make your passion into a reality. So many of us think I need to make a ton of money before I can go chase after my passions. No, that's not true. Sometimes you can create your passion and allow it to bring you to the point where you have a lot of money as well. It's usually a byproduct. But again, my experience is that the money goes one way. It's usually from the individuals that are creating it into the charity. Rarely do I see it coming back out, even in the form of salaries. They usually say they forego because there's so many other benefits of setting up that charity. The big one for personal benefit of setting up the charity that a lot of people don't realize is that you could write off, in many cases in 2021 and 2020, it was 100% of your charitable donation, which is can take, when I say 100%, it means like if I make 100,000 and I give away 100,000, I have zero taxes. Most of the time, outside of those dates, outside of express legislation that increases it, it's usually 60%. Or if you're giving appreciated assets like stock, cryptocurrency, real estate, if I'm giving it things that have gone up in value, I can write off against 30% of my income. So if I make $100,000 a year and I give it a house that I've had in my, for 20 years, that's maybe a rental house, and I give it to my charity to do affordable housing, I get the fair market value as a deduction limited to 30% of my income. I use that. So I'd only have to pay tax. Let's say I made 100 and I gave a $200,000 house away. I'd get $30,000 this year as a deduction, 30% of the 100. And I'd get $30,000 a year for the next 5 years, or until I use it up. So if my income goes up, obviously 30% is going to increase, but you're just going to carry it forward for 5 years until you use it all up. So I could get a pretty massive benefit. Let's say that $200,000 house was something I bought for 50,000 years ago. And that's not too uncommon nowadays, is you'll see a city just take off and, again, adjust your numbers accordingly, but you get a nice tax deduction. So there's a really good incentive for you to be the person behind setting up the charity and really pushing monies into it in the beginning and soliciting funds and trying to get other people. You do have something called a public support test that we have to worry about after the first few years, after 5 years, really 6 years, because the first year is granted. But you're looking at and saying, hey, I have to meet some of these tests. But otherwise, it's a fantastic tool just on the public charity side. If that's not you and you just say, hey, you know what, Toby, I just want to get money out of my estate. I'm not even so worried about the deduction. You still get a tax deduction, but it's going to be not quite those levels. Usually it's peaking out at about 30% for the private foundations, but maybe I'm setting up a private foundation and I'm just going to put money into it. And let's say I'm a real big advocate for animals, and maybe I'm giving it to PETA, maybe I'm doing local shelters. I just have to give 5% a year if it doesn't have an operation of something it's doing. So if it's not doing something tangible, like let's say affordable housing, but I still care about affordable housing, then maybe I'm setting it up as a private foundation. It doesn't do anything except give 5% a year to the United Way for its landlord services or something like that, or helping tenants. The United Way is a big supporter of low-income housing, and we work together with them. Catholic Charities, you name it. You could be very specific and say, hey, I'm going to put all these monies aside, but 5% a year needs to go over to these operating charities. So you have basically two different flavors. So I don't want to muddle the waters anymore. This was just a taste of what it looks like in the nonprofit realm. You have lots of different options, but there are some tremendous benefits that are sitting there. Some of you guys might be thinking about it, then just contact us and we could walk you through your actual factual scenario so that we could be more precise, and that you could see whether or not you can take advantage of some of the benefits of utilizing a nonprofit in your plan and creating your legacy, or how it might work in whatever's your interest during your lifetime, and say, here's some groups that I want to benefit. How do I integrate it in with all my other investments and my other businesses and my other plans, my personal plans? And we can certainly help you with that.